Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. We've got more information you're going to want to see where the Fed is actually giving us data that says the exact opposite about what they're saying with the banks. They're not in good shape. They're in big trouble, and we're going to show you why. Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob. So, it's funny because we keep pulling up data that shows the exact opposite of what the Treasury or the Fed is saying. They're saying, hey, banks are okay. We fixed them up. They're still resilient. And yet you found a graph that looks exactly the opposite.
It's just amazing to me, Phil. I mean, the chutzpah of these people is just amazing. They just, either they want you to keep you calm, right? Or they're selling out from underneath you and you're going to be the bag holder. But there's and the things that I really pay attention to when things don't happen that often, but when they happen, they're really significant. And this chart here, when it shows, I think you have the explanation on it first. Why don't we just throw that, I got 30 old eyeballs on for a second here. So there's a St. Louis Fed. And by the way, if you guys are interested in all Fed data, St. Louis Fed is like a treasure trove. This has a stress index. We've only seen it 4 times in the last 30 years, okay? And every time the VIX hit at least 45. Well, the VIX now is under 30, and every time it gets to 30, they've been beating it back. Is that moves like that have 2 things. One is you'll make a lot of money buying volatility, and number 2, you'll make a lot of money being short the market. And here's the graph of that indicator I just talked about here. Look at the VIX. Now, the VIX hitting 80 was in 2008. Now, it was just amazing. And by the way, when the VIX does hit 45 and hit 80, awesome time to sell volatility. You can make your whole year in one trade, okay?
How do they sell volatility?
Yeah, so you can buy puts on VXX or UVIX, or you can buy SVXY, and you can make money in the stock market. You don't have to get in the futures. You don't have to do anything exotic, and you can make really good money. I mean, that was my bread and butter until they blew up XIV. It was just an easy way to make money. And they've been suppressing it for so long that once the tea kettle goes, Phil, it's just going to be a bottle rocket. And that's what if you start getting VIX up over 30, that's scary enough. But you get VIX over 40, look out. You're talking 20%, 25% reductions in the stock market. And I think it's percolating, Phil, because we know about the banks aren't getting any better anytime soon. They're going to get worse. But this next chart I want to show you is just showing you how they're lulling you to sleep. They're basically giving you medication and sedatives and maybe having a few tokes of weed here, and they're like, everything's good, Bob, just relax, everything's good, shh, nothing to fear. At the same time, we're making lower and lower and lower new highs. And right. The market, the breadth in the market is collapsing because now we're down to the 7 generals. And then when this happens, a light switch goes off, Phil, as you know, and you get a big pop in the VIX for protection. You get a big dump in the market, and then just like Tiger Woods' mom, people are going to be saying, "What happened?" And why are we down so much? Everybody told us everything's okay. Well, here you go. They're warning you. This is the most telegraphed stock market crash in world history. If you're just willing to open your eyes, what say you, Phil?
Well, yeah, I wanted to go back to this financial stress index graph because what jumps out at me is that the stress index is much higher than the VIX, and that's not normally what you see. If anything, the VIX will jump first. So what it's telling me is that the complacency in the market right now is extremely high relative to the underlying risks that we have. And, we're still dealing with banking issues. And I know they're still telling us that, hey, banks are resilient. They keep using that word. My personal belief is that they're trying to prevent any more bank runs, because the last thing they want to do is keep expanding their balance sheet, backstopping these banks, because that's going against everything that they've been working on for the last 2 years. So they'd rather go out there and tell you, don't worry, all is well. And at the end of the day, that might be the case, but as a depositor, maybe. But if you're an investor in the banks, I would be pulling my money out, because these guys are on very, very thin ice. And if the indices start rolling over, these banks are going to suffer because they've got so much leverage tied to these markets. So it's going to affect their balance sheet and their bottom line. So yeah, if you're a depositor, I'm sure the Fed and the FDIC and the Treasury is going to come in and make sure that you're whole, much like what happened with Wachovia and WAMU back in '08. At the end of the day, your deposits were okay, even though they were insolvent. Somebody just came in, and then the Federal Reserve just made sure that it was backstopped, that over time, whoever took those accounts over would be made whole or get their money back eventually. So the depositors were okay. I think the same thing will play out again, but the Fed's really trying to keep it where, keep the hysteria down, because it's really making them swim upstream as far as what they want to do with rates and inflation. And say what you will about the balance sheet affecting the market or not affecting the market. The balance sheet expanding is just adding liquidity into the system, whether you're backstopping banks or not. That liquidity that the banks used to have went to somebody else, right, on the other side of the trade. But then you're giving the banks liquidity to backstop their bad decisions. And so you're adding liquidity to the system. Now, you can argue how much of that goes into the stock market, but I can assure you some of it does at some point. So the Fed just does not want to keep doing that. And so they're going to tell us everything's okay, despite their own data saying otherwise.
Yeah, I agree with you. And, even though it's not technically liquidity, as everybody's arguing with us, is if your deposits are banks backstop, the Fed wants you to start loaning money again. So that's liquidity in and of itself. And the more fear there's out there, the tighter the crediting is, the credit conversations you're going to have with your people that want to borrow money from you, and it's just going to get worse and worse. He doesn't want to lower interest rates, okay? He wants to maintain this because he's trying to achieve some sort of other policy goals here. But we keep slipping on these banks, Phil. It's bad news. In a sense, this is good news for the Fed. The Fed wants to wring out the speculative excess out of these capital markets so that money can be deployed into the real economy again. So the Fed would be quite happy if you and I were right here with a pretty big sell-off. People don't get that. People think this Jerome Powell is not in the business of backstopping Wall Street. He has a different mindset. People need to read his speech from 2013 to understand completely where his head is on this. And then it'll make sense for why we're going to get these big old stock market sell-offs and tightening credit over time. So, but here's simply the math, okay? This is not Bob and Phil making this stuff up. When these things happen, this happens. When you have confidence rates over 80% on something, you pay attention. When you have confidence rates that are 100%, okay, alarm bells should be going off in your head. So I thought it was important to share this, Phil, to kind of carry on from our conversation yesterday. Mm-hmm. And love to get the folks listening. I'd love to get your thoughts on this too.
Yeah. Let us know what you guys think and how you're positioning for this, and what your predictions are for the rest of the year with the markets. Other than that, thanks for watching. Please hit like and subscribe, and we'll see you on the next video tomorrow. Take care.
Trade Genius.